What if I told you you can save money each month by spending, get this, the exact same amount? So this is how you do it. If you're like most people, you work. And you work hard for your money. So let me show you how to save a little bit of it. It's very simple. If you have a loan, whether it be a credit card, a mortgage, a personal loan, it'll work. It works better if your interest is calculated daily, but it still works good if your interest is calculated monthly. So for this, we're going to talk more specifically about daily calculated interest. So if you have a loan, that interest, you make a payment today. From tomorrow onward until you make the next payment, it is calculating interest, whatever your interest rate may be, based off the principal amount, the total amount that you owe. So it will calculate every single day for 30 days based off of this one number. And then you will make that payment. Most of that will go to interest, and then some of it will go to principal. So here's the trick. If you take the same amount, let's say you owe, your payment's $100 a month. If you break that up, $25 a week. All you have to do is make that $25 payment every week. And what happens is, some of that money will go to interest to pay off the interest that has accrued for that 7 days for that week. But then a little bit will go to the principal as well. So let's say your base principal amount was $1,000. A little bit of that money will go to that $1,000, and now it's we'll say $980. So now you owe $980, but you're only in the first week of the month before your monthly payment is due. So your interest from that point for the rest of the month can only calculate based off your principal amount, which is no longer $1,000, it's $980. So it won't be as much. And then every week as you do that, the total interest the total principal amount that your interest is calculating off of is lower and lower and lower. So that way you're saving a little bit of money every single week by paying the exact same amount. And also, by paying weekly, you will actually get in roughly an extra month's payment, because if you divide it out, you have 52 weeks in a year, and you're making a payment every week. Well, if you're paying monthly, it's actually only like 48. So you're getting that extra payment in, and that generally will always go directly to your principal payment. And this can knock off easily on say a mortgage loan, for instance, a 25-year loan or a 30-year loan, several years, 2 to 3 years off of your the life. I've done this with several loans of mine. I've helped my parents do this, and it really does work. And to go a step further, if you have multiple debts, if you start with the smallest one and then get it paid off, and then whatever you was paying on that one, you put it to the next largest. So let's say you had a $70 a month payment, and you have a $150 a month payment and a $300 a month payment. So you pay, just make the minimum payments on these, but pay as much as you possibly can on the $75 payment until you get it paid off. And then start paying $75 on top of your $150 payment, and just focus everything on it that you can. And if you can pay extra, great, and pay that off as quick as you can. And then you now have the $75 payment, the $150 payment that you will be putting on top of the $300 payment, which will just bring it down even quicker. This is called the snowball effect. And I have used this as well with several different loans, as well as helping out friends and family members by showing them this, because you're already making the payment, and you have adjusted your lifestyle with having those payments. So just sustain that lifestyle a little bit longer, and then you can have everything paid off a whole lot sooner, saving you money and then hopefully giving you a little bit more financial freedom in the end.